Evening, everyone. So, we are here at the last session of my part, in which we have to be looking at the topic of leverages. So, the topic leverages, this is what we have to cover, or we have to complete that particular aspect. Let me just quickly recap as to what have we done in leverages, and then we'll start with the discussion on questions. We have done quite a few questions, and we will just continue the same thing to solve more questions. But just to initially begin with, leverages, it measures the level of risk. So leverages can be operating leverage, financial leverage, or combined leverage. Okay, so we can have operating leverage, financial leverage, and combined leverage. The operating leverage, it tells you what proportion of your operations are subject to risk, or it simply tells you that for 1% change in sales, how much will be the impact on the EBIT, right? So for 1% change in sales, what will be the percentage change in the EBIT? That is what operating leverage indicates. Then we have after that financial leverage, which tells you like for 1% change in EBIT, how much will be the percentage change in EPS? And combined leverage was finally for 1% change in sales, what will be the impact on the EPS? Okay. Uh, of course, we have the formula for that also, where we calculated this as percentage change in EBIT upon percentage change in sales. Then in financial leverage, we did it as percentage change in EPS upon percentage change in EBIT. And finally, combined leverage was percentage change in EPS upon percentage change in the sales. Then we also have seen the shortcut formula to calculate the operating, financial, and combined leverage, which was contribution upon EBIT. Financial leverage, it was EBIT upon PBT, and combined leverage, it was contribution upon PBT. Then we have done few questions, and let me just continue with these questions for discussion. Let us take this question number 3 to begin with. Okay, so let's have a look at this question. So from the following, prepare income statement of company X, Y, and Z. So it's not X, Y, and Z. It's actually A, B, and C. Briefly comment on each company's performance. We have companies A, B, and C. Their financial leverage, interest is given, operating leverage is given, variable cost as a percentage of sales is given, and income tax rate is given. I'll do one thing. I'll do the entire calculation and working for company A. Same way, can you do it for company B and C? Right? Can we do it, guys? I'll do for company A, and can you just then complete it for company B and C on your own? Right? Will you be able to do it, right? Okay, fine. So let us start with company A. Let me prepare the income statement first. So income statement start with sales less variable cost, which gives you contribution. And then you subtract the fixed cost, which gives you EBIT. Further, you subtract interest, which gives you PBT, less tax, which will give you profit after tax. Okay, so what are the numbers that we have? We have the numbers as interest of 200. Only one number is given to us. Rest all things are in the form of ratio and percentages. So interest is 200. Interest is 200. Right? And we have to compute the other values. Now, which is that leverage which is related with interest? Which is the leverage which is connected with interest? What type of leverage is connected with interest? Is it operating? Is it financial? Is it combined? Yeah. What type of leverage is connected with interest? Is it operating leverage? Is it combined leverage or is it financial leverage? What type of leverage is connected with interest? Yeah, tell me. Which leverage is connected with interest is? Which leverage is connected with interest? Which leverage is connected with interest? Of course, it is the financial leverage. Okay. So we know financial leverage. Financial leverage is EBIT upon PBT. So financial leverage is calculated as EBIT upon PBT. We don't have any of those numbers. Neither we have earnings before interest and tax, nor we have the profit before tax. So we can calculate this, or we can simply say that this is EBIT Okay. EBIT upon what's the PBT? It's going to be your earnings before interest and tax minus interest. EBIT upon EBIT minus interest. So this is supposed to be equal to EBIT on EBIT minus 200, and this financial leverage is equal to 3 to 1. Financial leverage is 3. Now, of course, we can solve this and say this as EBIT upon, or EBIT should be equal to 3 times of EBIT minus 600. Then take all EBIT terms on one side and the numbers on the other side. So you have 600 equal to 3 EBIT minus EBIT. So 2 times of earnings before interest and tax is 600. So what's the value of earnings before interest and tax? That's 300. So we have earnings before interest and tax as 300. Now we can obviously calculate the value of contribution, right? So EBIT is 300. Financial leverage we calculated the value of EBIT. Now I can use the operating leverage number because operating leverage is given to us as 4 is to 1. So operating leverage is contribution upon EBIT. It's contribution upon EBIT. And this operating leverage number is 4 is to 1. So this is 4. Contribution upon EBIT. This means this works out to be contribution upon 300 is equal to 4. Therefore, contribution is 1200. Contribution is 1200. We have the contribution as 1200. Can you tell me what will be the fixed cost in this case? What will be the fixed cost? Contribution is 1200, EBIT is 300. So what will be the fixed cost? Of course, fixed cost is going to be the balancing figure, which is 900. We can also get the profit before tax as 100. Tax being 45%, we get the PAT as 55. Okay. So you have 1200 contribution and we're reaching at a PAT of 55. Now we have to calculate the value of sales and variable cost. So we have variable cost as a percentage to sales is 66 2 by 3%. The variable cost as a percentage to sales is 66 2 by 3%. So let me use that ratio to arrive at sales. We have variable cost upon sales as 66 2 by 3%, which is nothing but 66.6667 upon 100. Now, variable cost to sales, uh, it is 66.6667 by 100. So we don't know what's variable cost. We don't know what is sales. But I can definitely write this variable cost number or variable cost expression as sales less contribution. Sales less contribution upon sales is 0.6667. Now, of course, sales minus the contribution number is 1200 upon sales is 0.6667. So sales minus 1200 is 0.6667 sales. So bringing the sales terms or S terms on one side, we have 0.3333 sales is 1200. So how much is the sale value going to be equal to? How much is the sale value going to be equal to? 3600. So we get the sale value as 3600. Of course, the variable cost is 2400. And here we complete this calculation of the company A. Did you get it, everyone? Calculations of company A. Yes. Is it clear to everyone? The entire income statement of company A is complete with the use of operating and the financial leverage. So will you be able to do the same way for company B and C? Can do the same way for company B and C? Yep. Same way you have to use financial leverage and operating leverage to arrive at these numbers, and then the variable cost as a percentage to sales to arrive at the sale value. Can we do it? Yes. Daksh, Arun, Anchal, Vedant. Yes. Okay. Go ahead. Start with question number 2. I mean, not question 2, but for company B and company C. EBIT 400. Then you have interest. Interest is given as 300, right? Says 100. Tax 45. PAT is also 55. Okay. Then for company C, it is sales is 12,000. Variable cost is 6,000, right? Then you have the contribution also as 6,000. Um, Fixed cost is 4,000. So this gives you what? 2,000. EBIT is 2,000 and their interest is 1,000, right? PBT is 1,000, tax is 450, and this is 550. Okay, so that's 55, 55, and 550 as the profit after tax. Okay, did we get it, everyone? PAT works out to be 550 for the last one. Yes. Okay, fine. Then let's go for the next aspect. Question number 4. The operating income of a textile firm amounts to 1,86,000. So what is this 1,86,000? What is this 1,86,000 denoting? EBIT. Absolutely correct. That's EBIT. It pays 50% tax on its income. Its capital structure consists of following: 14% debentures, 5 lakh, 15% preference shares, 1 lakh rupee, equity shares of rupees 100 each, 4 lakh. Determine the firm's EPS. Determine the percentage change in EPS associated with 30% change, both increase and decrease in EBIT. So we have to first complete the income statement, determine the EPS, and then we have to see if the EBIT is changing by 30%, what will be the new EPS? Then determine the degree of financial leverage and additional data you need for computing operating as well as combined leverage. Okay. So let me just take it as it is. Okay, so we have the EBIT numbers over here. EBIT is 1,86,000. From that, of course, we will subtract interest. Right, so we'll subtract the interest. We'll get PBT less tax will give us profit after tax. Further, subtracting the preference dividend will give you net profit for equity shareholders. Then you divide it by number of equity shares, which will give you EPS. So I think you'll be able to solve this part, right? Can you complete this part, everyone? From EBIT till EPS? Yes? Can you complete it? Yes or no? We have all the information, debentures, preference shares, and everything is given to us. So we can definitely complete this entire part and arrive at the EPS. Okay, so right. Yes, Daksh, you are saying something. Yes,
Good
Daksh.
evening, sir.
Yeah, good evening, Daksh.
Sir, at any time in the examination, do we need
Hmm.
to draw the tables for the income statements?
Of course, yes.
Okay, sir.
Okay. Then you can get the EPS. And then for the second part, it says 30% change for both increase and decrease. So we need to get the uh, EBIT increase by 30% and EBIT decrease by 30%. So if your EBIT increases by 30%, so 1,86,000 increasing by 30% is 2,41,800, and this into 0.7, which is 1,30,200. Okay. Recalculate the EPS numbers for all the scenarios, because based on that, we'll look at what is the degree of financial leverage and everything. For the interest payment, in the first case, we have 15% debentures, 15% of 5 lakh, that's 70,000. And we have the PBT as 1,16,000. Tax is at the rate of 50%, that's 58,000. PAT is also 58,000. Reference dividend is 15,000. Net profit for equity shareholders is 43,000. Divided by the number of equity shares. Number of equity shares is 4,000. So EPS at current situation, it is what? 10.75? 43,000 divided by 4,000. Yes, 10.75. Now, check for the EPS at the other two levels. When the EBIT is increasing by 30%, the EPS is what? 17.725. and in the other case it is 3.775. Are we getting this? Yes. 17.725, 3.775. Okay. So now we have to look at the third part, determine the degree of financial leverage. Okay. So financial leverage. How do we calculate the financial leverage? Don't tell me the shortcut one. Right now, let's go for the long cut one. Financial leverage is percentage change in EPS or a percentage change in EBIT. Okay. So first, let us compute the percentage change in EPS. The percentage change in EPS is 17.725 minus 10.75. 17.725 minus 10.75 divided by 10.75. Percentage change in EPS is 17.725 minus 10.75 divided by 10.75. Okay, so this comes out to be 17.725 minus 10.75 divided by 10.75. So this percentage change is how much? 64.88%. So change in EPS is 64.88% or 30% change in EBIT. So 64.88 divided by 30. This is 2.1626. This is your financial leverage 2.1626 as per the original formula. But if I just use the shortcut formula, which was EBIT upon PBT. So EBIT upon PBT, EBIT is 1,26,000, sorry, 1,86,000 divided by PBT of 1,16,000. Just check what is this number? 1,86,000 divided by 1,16,000. This comes out to 1.6034. Of course, both of them are not matching, right? So, of course, this one is incorrect. This one is incorrect because this one works only when there is no preference dividend. But here we have preference dividend in our income statement. So I'll have to revise this formula. So the revised formula is EBIT upon PBT minus preference dividend upon 1 minus T. Right? So for current level, of course, even if they ask you for current level, we have the preference dividend, right? We have the preference dividend at current level. So this is going to be 1,86,000 divided by 1,16,000 minus preference dividend is 15,000. So 15,000 upon 1 minus 0.5. So this is 1,86,000 divided by 1,16,000 minus 30,000. Okay. So that's 1,86,000 divided by 86,000. Just apply this formula. 1,86,000 divided by 86,000. Now you can see you're getting the same answer which you were earlier having, 2.1627. Okay. So either you can use this original formula or you can use this shortcut formula, which is a correct one. This particular shortcut formula is the correct formula. Okay. This is the correct formula because there is preference dividend element in our income statement. So earlier, this formula when it was derived, there was no income statement, there was no preference dividend element in the income statement. Okay. Concept of margin of safety, break-even point of sales, and graphs in module. We are yet to discuss those things. So, but of course, we can discuss on what is financial leverage as a double sword. Financial leverage, as we say, it magnifies your earnings per share for very small efforts in sales. So therefore, it's a double sword. It's like if you increase your sales a bit, your EPS is going to increase rapidly. Similarly, if your sales decreases or EBIT decreases a bit, there will be a rapid impact on the EPS also. So it's good as well as bad. So it's like a double-edged sword. It could be a good thing and it could be also a bad thing. And trading on equity, we have already seen in the chapter of ratio analysis. Okay, fine. So now with that, I think we should be able to go ahead with question has fourth part. Yes. Which additional data do we need to compute operating as well as combined leverage? Now, of course, we have got the EBIT number. The only information that we need, what is the additional information we need for operating leverage? What information we will need for operating leverage, guys? What information will we need for calculating the operating leverage? You have EBIT, you just need one information, which is contribution, right? So contribution is additional information that we need to have. Okay, fine. Let's go for the next question. Let us go for question now. Yeah, let's go ahead with try out this question number 8. Try this question 8, guys. Try to solve this question number 8. You have the sales, you have the interest, operating leverage is given, combined leverage is given. So pretty easy question. Try to solve it. When they say, Ananya is asking 20% increase in sales, can we say that in working on the variable cost and contribution? Yes, you can do that, Ananya. Okay, so financial leverage, we have the number of combined leverage. We know combined leverage is going to be equal to operating leverage into financial leverage. So combined leverage is 2.16. That's equal to operating leverage into financial leverage. So financial leverage is going to be 2.16 divided by 1.2. So 2.16 divided by 1.2, which is 1.8. So financial leverage is 1.8. Then we have to get the fixed cost number. So we need to, of course, start with the income statement to begin with. So we have sales less variable cost, which will give us the contribution number. Sales less variable cost gives us the contribution less any fixed cost, which will give you EBIT less interest is PBT, okay, less taxes. That's going to give you PAT. So we have the sales figure as 100. Then we don't know the variable cost, but we have the interest as 10. So sales is 100 and interest is going to be 10. Operating leverage is 1.2. Combined leverage is used to now, of course, in relation to interest, we have to use the financial leverage number. Financial leverage is 1.8, which is nothing but EBIT on PBT. Now we can obviously apply this shortcut over here because there is no preference dividend over here. So 1.8 is EBIT upon EBIT minus 10. So 1.8 times of EBIT minus 18 is EBIT. So we have 0.8 times of EBIT is equal to 18. So this EBIT number is 18 divided by 0.8, which is 22.5. EBIT is 22.5. PBT will be 12.5. And then since we have the operating leverage also, we'll use that. Operating leverage is contribution upon EBIT. So operating leverage is 1.2 is equal to contribution. We have this as contribution divided by EBIT number, which is 22.5. Contribution is 22.5 into 1.2 is 27. Contribution is 27. Fixed cost will be 4.5. Okay, so we got the fixed cost value also. Financial leverage is anyways done. Now the PV ratio. PV ratio, we know it is contribution upon sales. So contribution is 27 upon 100, which is 27%. So PV ratio is 27%. Okay, so that completes this question number 8. Are we good, everyone? Question 8. Yep, okay. Okay. So now just try out this question number 10, guys. Try this question 10. Financial leverage, we don't have dividends. So instead of PD, what should we take here? There is no preference dividend. So preference dividend is 0. Okay, so this question 10. What's earnings per share? Are you getting the earnings per share as 14.4? Operating leverage is 1.3. Financial leverage 1.125, and combined leverage is 1.45. Okay, combined leverage, you can just multiply operating and financial to get the combined leverage. Okay, fine, great guys. So let's just take a break now. And after break, we'll be discussing about the margin of safety and break-even point concept to solve certain questions. Okay, so let's take a break, guys. continue. You have a doubt in calculation of sales and EBIT. Vedant is having a doubt. Okay. So we have this total asset turnover is 2.5. So total assets turnover is 2.5, which is computed as sales upon total assets. This is 2.5 is sales upon total assets is 40. So sales will be what? 100. Got it? So sales is 100. And then, of course, you can say your sales is 100 less the variable cost. Variable cost is 65%. So that's 65. You have the contribution as 35 less the interest payment. Interest is 15% of 20. Now 15% of 20 is 3. So you have EBIT as 32. Sorry, not EBIT, my bad. I need to subtract the fixed cost over here. And then we get the EBIT. So for fixed cost, it is 8 crores. Fixed cost is 8. So we have the EBIT as 27. Then you subtract the interest of 3. So you have PBT as 24. Okay. And then now you can obviously say what's the operating leverage combined and other things. Operating leverage will be contribution upon this. Contribution upon EBIT. That's 1.3 financial leverage and then the combined leverage. Is it clear, Vedant? Very good, Vedant. Yes. Okay. Now, before we do this question number 12, we need to look at a concept called as break-even point, margin of safety. Okay. Let's try to understand what is this break-even point and margin of safety. Let us say we have sales of 1000. From that, you subtract the variable cost, let's say 600. So you get the value of contribution, which is 400. And then further, you subtract the fixed cost of certain thing, and then you have the EBIT number. Now, if fixed cost is also 400, you can say EBIT is 0. So what is break-even point? What is break-even point? Break-even point is the level of sales. Break-even point is the level of sales at which your EBIT is going to be equal to 0. Okay. So when we say break-even point, it is the level of sales at which EBIT is 0. Okay. So right now, of course, we can say that this particular number is break-even point. Okay. This particular number is simply the break-even point. Now, what happens if your sales is more than break-even point? What would happen if your sales level are more than break-even point? Your sales is higher than break-even point. What will happen to EBIT? if the level of sales is more than break-even point, what will happen to EBIT? EBIT is going to be a positive number or a negative number? Yeah. Obviously, the EBIT numbers are going to be positive, right? So now let us say the break-even, the sales is 1200. So what will be the value of EBIT then? Because sales is 1200, what is the value of EBIT then? Of course, this is going to be 600. Contribution will be, sorry, variable cost will be 720 because it's going to be 620. It's going to be 60% of the sales. Then you have the contribution as, how much contribution? It's going to be what? 480. Fixed cost is going to be 400. And we have the EBIT level as 80. I can say EBIT is 80, which is a positive number. Sales is 1200, variable cost is 720, contribution is 480, fixed cost is 400, and your EBIT is coming out to be 80. Okay. So now, since our sales is more than break-even point, uh, that's what we call it as margin of safety. That is what we simply call as margin of safety. So how much is the margin of safety over here? How much is the margin of safety over here? What is the amount of margin of safety? What is the amount of margin of safety? Yeah, guys, margin of safety is sales minus break even point. So, which is in our case, 1200 minus 1000, which is 200. Right? So, margin of safety is the value of sales above the break even point. It is the value of sales above the break even point. So, over here we say it is 200. So, now my question is, what will be the margin of safety percentage? How much can we say about margin of safety percentage? Margin of safety percentage. Yeah. What's the margin of safety percentage over here? Well, margin of safety is 200, and this is going to be a percentage of sale value. So margin of safety is margin of safety percentage is margin of safety upon sales into 100. So over here it is 200 out of 1200, or I can say out of total sales of 1200, 200 is something that is having a margin of safety. So this amounts to what percentage? 200 divided by 1200. What is the percentage? 16.67%, right? 16.67% is the margin of safety percentage. Okay, margin of safety 16.67%. Okay, now let's try to do some sort of working on this. Margin of safety percentage is sales less break even point sales less break-even point upon sales. Okay, so margin of safety is derived by this particular number, which is sales minus break-even point upon sales. Okay, now let us do one thing. What would happen if I multiply both numerator and denominator by PV ratio? If I multiply numerator and denominator by PV ratio, how much is it going to be? So this is like sales multiplied by PV ratio minus break even point multiplied by PV ratio. And then the whole thing divided by sales multiplied by PV ratio. Okay. Now tell me, what is sales multiplied by PV ratio? What is sales multiplied by PV ratio? Sales multiplied by PV ratio. Can I say sales multiplied by PV ratio is contribution? Okay. So sales multiplied by PV ratio is contribution. And even in the denominator, we are going to have this as contribution. Now, what is break-even point multiplied by PV ratio? Break-even point multiplied by PV ratio. What is break-even point multiplied by PV ratio? Yeah. Okay. Okay. Let me just remind you something. How do you calculate break-even point? Formula for calculating break-even point? Can I say it was fixed cost upon PV ratio? Fixed cost upon PV ratio. Break-even point was calculated as what? Fixed cost upon PV ratio. So obviously, if I multiply break-even point with PV ratio, then the answer is going to be fixed cost. So of course, here I'm going to subtract the fixed cost. Now, when you subtract fixed cost from contribution, what is left out? As we said, break-even point into PV ratio gives you the fixed cost. Now, if you're subtracting fixed cost from contribution, what is left out? EBIT. So we have earnings before interest and tax upon contribution. Does it seem to be like inverse of some formula? Does it seem to be inverse of some formula? Does it seem to be inverse of some formula? Yes. It is simply 1 upon operating leverage. Right? So we can definitely say margin of safety percentage is 1 upon operating leverage, or we can also say this simply implies operating leverage is 1 upon margin of safety percentage. So operating leverage is also calculated as 1 upon margin of safety percentage. I hope this formula or this derivation is clear to everyone. Yeah, fine. So operating leverage is 1 upon margin of safety. So now once we have done this formula, we should be able to solve this one. Okay, fine. So try to solve question 12 now, everyone. Try to solve question 12. Margin of safety over here 0.25 or 0.2 means 20% and 25%. You can take the numbers as it is. You can take margin of safety as directly 0.2 in the denominator to arrive at operating leverage. Yep. So for company A and B, both we have the margin of safety numbers. Now, the margin of safety numbers will be used for calculating the operating leverage. Okay, so let me do it simultaneously for both companies, company A and company B. We have the margin of safety as 0.2, 0.25. So operating leverage, as we said, 1 upon margin of safety. For company A, margin of safety is 5, and for company B, margin of safety is 4. Sorry, operating leverage is 5 and 4. Uh, Now we do have the financial leverage numbers as 4 and 3, and we have the interest also as 3,000 and 2,000. Now this becomes more of like a one of the previous questions, right? You start with the financial leverage, which is EBIT upon PBT, and then carry it forward. I think you should be able to solve it now. Okay, let me do it for company A, and same way you can do it for company B then. Company A, we start with sales less variable cost. That gives you contribution. Then you further subtract fixed cost to get EBIT. Then you subtract interest to get PBT, and less tax to arrive at profit after tax. Okay. Now, since we have the number of interest, you can write it over here. So we start with financial leverage. So financial leverage is calculated as EBIT upon PBT. The financial leverage is 4. That's equal to EBIT upon EBIT minus interest. So 4 is EBIT upon EBIT minus 3,000. Okay. So you can say 4 EBIT is equal to so it's 4 EBIT minus 12,000 is equal to EBIT. So 3 EBIT is equal to 12,000. So the value of EBIT will be 4,000. EBIT is 4,000. You get the PBT as 1,000 and we have the tax rate as 45%. So 450 is paid out and you have the 550 PAT. Now we look at the financial leverage, which is, sorry, financial leverage is used. Now operating leverage is 5. So let's use that operating leverage. Operating leverage is contribution upon EBIT. So the operating leverage is 5. That's equal to contribution upon 4,000. So what's the contribution number? Contribution number is 20,000. Of course, if contribution is 20,000, fixed cost is 16,000. And the question says that there is a PV ratio of 25%. So PV ratio is 25%, which is contribution upon sales. So 0.25 is equal to contribution is 20,000. Contribution is 20,000 divided by the sales figure. So we have the sales number as 80,000. Sales for the first company is 80,000, variable cost being 60,000. Got it, everyone? Can you tell me what's the sales for company B? What is the sales for company B? Sales for company B is 36,000. So sales for the second company for company B. So here we have sales this as 80,000 and if you get this as 36,000, this is going to be absolutely correct. Now, since operating leverage is for operating units, we do not have any reduction as tax rate and PD in the formula. Yes, Daksh, you're absolutely correct. Okay, so that's question 12. Now let's go for the next one. Okay. Try out question number 13 now. Try this question number 13. And let me put up a timer also for this. Question number 13. Be able to do within 12 minutes. Yeah. Okay. Try this. Solve it. Question 13. Okay, done. Let me just show you the answer for that. That was question number 13. Okay, question 13. We had equity share capital 15 and 20% decline thing. Okay, yeah, so this is the answer. So you have the EPS as 604, 424, and 364. This was the question. Question number 13. Okay, just check the answers, guys. Just check if you're getting these EPS and the leverage numbers. Where we supposed to take the units value or rupee value? Take anyways, answers are going to same come up to be same. Okay, now let us do few MCQs. Okay, so here we go. You got everything different. How did you get everything different? Sales was given, variable cost per unit is given, units is given. So per unit, you just need to multiply by the number of units to complete this. Degree of operating leverage is 1.88 in the original case. How did you start the calculation? I think the numbers are quite clear. You have the units, you have the sale price, you have the variable cost, you have the fixed cost. Interest also can be computed easily. So there's nothing, to be worrying about. Okay. Anyways, the first one, a firm is having a contribution of 5 lakh and EBIT is 3 lakh. What will be the degree of operating leverage? What will be the degree of operating leverage from this? Contribution is 5 lakh and EBIT is 3 lakh. So what will be operating leverage? Operating leverage, we can say it is simply 5 lakh divided by 3 lakh, which is 1.67. Okay. Then answer for question number 2. what does the word degree of operating leverage mean? It's same as operating leverage. Second question, if your EBIT is 4 lakh, interest is 1 lakh, tax rate is 30%, degree of financial leverage is how much? So what will be the financial leverage term? Degree of financial leverage in this case. So degree is EBIT upon EBIT minus interest, which is 4 lakh upon 4 lakh minus interest. So which is 3 lakh. So 4 lakh divided by 3 lakh, answer is 1.33. So answer is 1.33. Okay. Fine. Then let's look at question number 3. Operating leverage is 2.5. Financial leverage is 1.6. What is the degree of combined leverage? Question 3. So degree of operating leverage is 2.5. Financial leverage is 1.6. What will be the degree of combined leverage? The degree of combined leverage is simply going to be a multiplication of both, which is 4. Okay. Then question number 4. Which of the following best measures the business risk in the context of leverages? Which of these is going to measure the business risk? Financial leverage, combined leverage, operating leverage, or total leverage? Financial leverage. Is it? The business risk is going to be measured by financial leverage. Business risk. Business risk is only operating leverage. The operating leverage, financial leverage is for the financial risk, and total leverage is for the total risk of the business. Now, answer question number 5. Okay. Yeah. So I think the questions are well answered. So we have completed this topic of operating leverage. We have done the concepts along with the applicable questions. Okay. So with that, we are coming to answer for the fifth MCQ. And fifth was 30%. Fifth was 30%. Will there be lecture for practice of cost of capital? Well, we had the lecture, right? Cost of capital last Sunday. We had the revision session. Okay. So with that, let us stop here for the day. And in fact, I'm completing my part for the time being. So we have done ratio, sources of finance, leverages, cost of capital, and capital structures. I think I have uploaded the notes in last Sunday or yeah, last Sunday only I've uploaded it. You're not able to see it? It's not visible? No? Okay, then let me see. Let me check with the admin whether they have released it or not because they need to approve it for that you can see it. Okay, so I'll ensure that it is done. Okay, so with that, let's just stop here for the day, guys. See you in the next class, guys. Bye bye.
Recording stopped.